Hello and welcome. I am Piers Ridyard, CEO of the decentralized finance protocol Radix, a public ledger entirely dedicated on bringing DeFi to the mainstream. This is our podcast, The DeFi Download, a show about decentralized finance and all things crypto, where we dive into the details of the projects, assets, and services that are powering the DeFi revolution. Today, I am joined by Red, foreman at Harvest Finance, a yield farming aggregator that automatically searches for the best DeFi returns possible and makes it easy for users to deposit and know that they are always getting the best possible DeFi yields on their assets. Red, thank you so much for coming on the show.
Thank you for having me. Appreciate it.
So for some people, like, yield farming has been around for a very long time, and other people, they're just like, I don't know what yield farming is. So like, just as an ELI 5, what is yield farming and why does it matter?
Sure. So yield farming is like the purposeful intent of a user trying to put like their stagnant assets to work, right? So if you have Ethereum that's just sitting in your wallet, it's not really earning you anything, and its value is based on like just open market valuation, right? Pretty much speculation. Yield farming is trying to put those assets to work on different protocols that exist within cryptocurrency, specifically like on Ethereum, where a lot of decentralized finance is occurring. So like a protocol like a decentralized exchange by nature is just simply a bunch of code written that operates as an exchange. But an exchange, like if you walk into a bank, you want to trade USDC for euro because you're going on a European trip or whatever it is. The bank has a bunch of backing institutional investors. So there's a bunch of money sitting there and they can make the trade for you very easy. There's a bunch of liquidity.
Right.
A decentralized exchange, again, being just a bunch of code, there's no money sitting there.
Right.
So the way that code works is there's reward tokens that incentivize people to say, hey, provide liquidity to our protocol. And the longer you provide liquidity to us, we will stream rewards tokens that have some kind of intrinsic value to them.
Right.
So yield farming, so tying that all together, is basically yield farming is taking your assets and trying to put them to work at these various protocols so you can collect those rewards, i.e. yield, and that basically generating you a passive income on, say, your Ethereum or your digital dollars that you wouldn't get if they were just sitting in your wallet. So that's the concept of yield farming.
Got it. And this sort of came out of the original need or the requirement for liquidity, right? Like when we built these, when DeFi first created these kind of things like decentralized exchanges like Uniswap, the way that they work is intrinsically there has to be people who are providing liquidity to them. So if I have the USDC versus ETH pair, the way that actually allows people to swap between USDC and ETH is that people have provided in the current price ratio, the assets on both sides of the pool, right, into that pool. Now for USDC and ETH, not so many problems. Like lots of people have got USDC and ETH, and lots of people wanted to trade it. So when Uniswap was launched, people were like, "Oh, cool! I'll put my assets to work here." But then there was this whole secondary market of smaller tokens that came along, and it wasn't so trivial to create the liquidity. And that for me, that's where yield farming started to be spoken about. Would you say that's sort of accurate, or do you see a different trajectory on the story there?
Yeah, I mean, ultimately, in order to get people to, in a sense, stand out from the crowd, in a sense, you need to offer some rewards to incentivize people to come and place their liquidity and almost take that risk of placing that liquidity with you. So, yes, in some respects, it's one way to help bootstrap your project. Another way, it's a very good way to distribute your token, because a lot of these are like governance tokens, and for these protocols to be able to operate continuously, they may need some voting or updates within their protocol. That's going to require a very diverse set of token holders to be able to signal, appropriate voting within that protocol. So, there's probably a bunch of different reasons, why yield farming or this way of kind of in a sense fair launch, which came from like Andre Cronje's launch of YFI. And I think that's really what sparked the fire of yield farming, because it was a way to get past what ICOs were doing And typically, like projects holding on to 70% of the tokens for themselves, only selling like 10%, maybe the other 20% are going to like some influencers or VCs. And so you can see this huge imbalance there, right? It's basically very centralized. So I think yield farming and this kind of like idea of fair launch kind of took this synergy to a next level and said this is probably the most fair way to hand out tokens to these protocols, as opposed to an ICO where you were actually physically exchanging your Ethereum for a token, and that token could be worthless because they were also maybe based on a white paper, not actually a working protocol. Whereas now in yield farming, hey, provide liquidity. It's kind of like a we'll prove it why this token is valuable, because you can see the protocols here. The liquidity is doing what it needs to do. Now you have the option, you can kind of sell that token immediately, or you can hold on to it because you actually have some belief in the token. So I don't know if that kind of answers your question, but
Yeah.
I think there's just kind of a lot of nuance in, why yield farming kind of came to be, and then why it's sustainable too. Because if you look at like a protocol like Curve, I think they have like a distribution out for like 40 years or something like that, right?
Right.
But that's sustainable because again, their token is kind of connected to like a revenue stream. So like anytime somebody performs a swap, there's a little bit of a fee, and then that gets doled out to token holders. So if there's a lot of people performing swaps and it's actually a good protocol and used, then there's actually value going to that token, even though there may be like a printing curve over 40 years, right? So not to get into all the economics of that, but again, that's why these things can be very sustainable, and why they can be good and needed for the ecosystem.
So let's talk about fair launches and governance tokens, because I think it is a really interesting area in DeFi, and it's super important. So from the point of view of like taking Harvest Finance as the model, can you talk a little bit about how you guys did your launch, and like what function the governance token provides to Harvest Finance and why it's important, and just a little bit more about the ethos of fair launches? I think it's a really interesting topic as well.
Sure. Harvest Finance is a little bit more unique because we were almost like a commune kind of thing. Week one, Harvest Finance launches the core devs launch this product, a yield farming aggregator, and Farm Token is its token, which basically taps into the revenue stream. So depositors, they deposit their funds, those go to a strategy, they're making money, and then 30% of any profit issued flows to the token holders, right?
Okay,
So that's
so
kind of the
I'm going to
purpose.
stop you there because we're going to
Sure.
have to explain all of those things before we go into the
Okay.
the governance token. So let's start with strategies. Like what a strategy like give me the more tangible examples you can give of a strategy, sort of I think the more real we can make it for the listener. So,
sure. So I mentioned Curve Finance earlier, decentralized exchange. They give out the CRV reward token for depositing assets and providing liquidity to their exchange, right? So as we explained earlier, they need individuals like me and you to come and provide liquidity. So there's plenty of depth and people can trade between all these various pairs. So one of the quote unquote strategies, or a basic strategy, is users come to Harvest Finance. They can deposit USDC, a dollar stable coin. Harvest pools all that money together. So while you may only deposit 5,000, there's other users depositing 1,000,000, 100,000, 10,000, $5, whatever it is, all pooled together in mass, deposited at Curve. And now it's collecting those CRV reward tokens in mass. And then every day or every few days, the system will perform what's called do hard work, which is basically a harvest to say, give me all the CRV tokens that we've been rewarded over the past 3 days and sell them all to USDC coin, or whatever the initial deposit was, or whatever the strategy is. So in this case would be USDC, deposited to Curve, earning the CRV token, sell those. Maybe you get $10,000 in rewards. That then dumps back into the pool of USDC or compounding, and now instead of earning on $100,000, it's now earning on $110,000, right? And so that's what compounding is. And so that's what a strategy, a very basic strategy is users come deposit that USDC with Harvest, Harvest moves it over there, performs that harvesting and compounds the money for you. As opposed to, like, if you're an individual farmer, you could go to Curve directly yourself and deposit the USDC and collect the CRV, but that's APR when you're just simply collecting the CRV and it's piling up in a stack, right? You're always earning on your original $5,000, whatever you deposited, until you perform the steps of selling the CRV and redepositing. So what Harvest does is does that all automatically for you, the harvesting and selling of the rewards and redepositing and performing the compounding. And if you kind of know what Ethereum, sometimes Gwei can jump up to like 500 to 1,000, 2,000, whatever's happening. So sometimes that can be very cost ineffective for an individual user. If I only have $1,000, let's say, deposited, my rewards equate to only $10. But if network fees are $300 just to harvest and compound, obviously I can't compound for 6 months until rewards are accruing. But when you're kind of like carpooled all together in Harvest Finance, with a bunch of other depositors in the same asset, they can do that every couple of days, and now the cost is only fractions of a penny to you. So cost savings and automation is kind of the point of Harvest Finance and yield aggregators in general.
So it's sort of like there's lots of things going on here, and they're all really interesting. So one of them is you would put your assets to work anyway. You could put your assets to work anyway in something like Curve, which is a decentralized exchange for allowing people to swap between like pairs, so USDC to USDT or something like that, right? And there's these pools that mean that people want to come along and they want to swap between these stable pools or stable tokens all of the time, and that you will get actually just fees for doing that, because the users have to pay a fee for actually using Curve in the same way you do have for Uniswap or for SushiSwap or any of these platforms. So you would do that. That makes money. That's cool. But Curve have added this extra kicker, which is what you were talking about, like lots of projects doing, where they're like, hey, if you actually come and provide liquidity, we understand that makes our protocol better. So what we're going to do is we're going to give out tokens to people who provide liquidity. This is the CRV. And then what yield farmers realized is that, well, actually what we can do is we can treat we can take those tokens we get and just sell them into market periodically to realize the returns on the extra value that we're being given by these tokens. So there's people out there who are looking at Curve and they're going, hey man, I would really like to hold some Curve tokens. I'm interested in buying Curve for its underlying properties. But then you have these liquidity providers who are going, well, I'm just here to provide liquidity for the market. I'm not actually trying to speculate on these projects directly. What I just want to do is I want to increase my returns. So I'm getting these CRV tokens, but to get them, I have to do a claim process against a smart contract. And on Ethereum, because it's super congested, as you were saying, it's going to cost lots of money. So I have this problem of the more time it takes me to claim back and actually sell out of those tokens to get it back into the asset I care about, say USDC, the more risk I'm taking actually on the price as well. Whereas if I have a way of calling these tokens more regularly and selling out a little bit on market, I'm not creating sort of big dumps on the market. I'm just like a steady sell, and I'm always making sure I'm realizing profit on that as well. And what Harvest is doing, which is really cool, is this carpooling concept that you talk about here, is this idea that, well, actually what you need to do is a smart contract call, and that smart contract call could be for $10 or it could be for $10,000. So if we create another smart contract, the Harvest smart contract, that controls all of these funds, we now get to aggregate a call against the Curve smart contract, so that we can now do a call for all of our farmers, whether or not they've done $10 or $1 million worth of USDC liquidity into the Curve pool. And now you can sell more regularly and not have to take the issue of fees. So do you think that, given all of that, do you think Harvest is only the use of Harvest is only really because the congestion on Ethereum, was that the pain point that came along, or was there more Is there more, like you talk about automation as well? Like, what would you say is the more important side of those two coins, or are they about 50-50?
I can touch on those 2 points, but I think there's a third point, which is like security and ease of entry into DeFi. But like on the first two, it's yes, the cost savings is very important. Hopefully those things are going to be resolved in Ethereum, and then you see other like layer twos or side chains, whether like they're Binance side chain or Matic or Polygon, which is now called. And so, yeah, so hopefully a lot of times that, or in the very near future, that cost associated with yield farming is going to go away. But the automation portion is very important because it introduces kind of a decision point. So, and you kind of touched on it a little bit. As an individual farmer, if I'm going to curve, I have the decision make. Do I want to hold on to these CRV tokens because I think, hey, this is a really great product. They may have more value in the future, or hey, this pays a dividend, so I want to stake this token. I want to collect the dividend and create a passive income that way. Really believe in curve. That's one decision. Or you can use a harvest finance, which is, they're going out and farming the curve token, but selling them to get you an immediate realized profit,
Right.
to compound what your initial deposit is, right? And so that's a completely different dynamic, because if I deposit USDC, I want more USDC, right? So to make it like ELI5 simple is Harvest tries to be in a sense like a high-powered savings account for whatever you deposit with us, right? Because if I deposit USDC, I'm getting more USDC back, and I'm getting it at an insane rate, right? Like even if you're fluctuating between like 10 all the way up to like 40 to 60%, and this is really dependent on the market, right? Like if we're in a bull market, CRV token is worth $10, your return to profit is going to be a lot greater than if you're in a bear market, CRV is only worth $3, right? So sometimes the percentages can be as high up as 70% APY, point in time return extrapolation, right? 70 times the amount any fiat bank will give you, right? So you can see why it's so very popular. So again, going back to like just being harvest finance, it's better to think about it as, hey, this is a very high savings account. Whatever I deposit into harvest, that's what I'm going to get back more of, as opposed to if I deposit at 5,000 USDC at Curve, that I'm going to get that $5,000 back, and then a pile of CRV tokens that I need to decide what to do with, right? Then the third thing is security, right? This is the third point. You walk into DeFi and there's farms everywhere. And if you don't know how to read code, you have no idea if those farms are secure, right? So I can deposit $5,000 at some random Meerkat protocol because they're offering me 1,000,000% APY if I deposit my USDC there.
Sounds
Sweet
great.
gold rush, and I rush there and I deposit money. But unfortunately, in the code, there's a backdoor that you don't know about where it's basically called a rug pull, where the developers can just pull all the money in the accounts and run away. And because there's a lot of anonymity behind blockchain, your money is now gone forever, right? So the third thing that Harvest tries to do is that we only implement, or the core devs only implement strategies that are deemed safe, right? Now, not everything's 100% safe, but they've basically done a review of the code and say, hey, there's no backdoors here. We don't see any way that funds can be purposely stolen with malicious intent by the creators. That's not to say some hack or something random goofy in the code, poor programming doesn't exist. It's just, do these certain things that exist in smart contracts that allow developers or code writers to instantly steal funds, do those exist? So we try to do this almost like soft security check for users. So when you come to Harvest Finance and deposit your USDC, you can feel like that there's a good probability that you're relatively safe. Again, I'm trying to be very cautious of these words because there's a lot of risk in DeFi. There's a lot of risk in what's called money Legos and composability. Us connecting with somebody else's code, again, if there's one fault in that code, that can create a domino effect, which people depositing Harvest lose money because we're relying on those people's code to be safe. So there's a lot of vetting that goes on before any of these new strategies or us being willing to connect to another protocol. So again, that third third aspect is if you pretty much see it listed at Harvest, we're comfortable that that's like not a scam project that you can lose your money instantly on, right? That's not a guarantee, but it's one of those things that, like, in a sense, if I was just somebody walking into DeFi and I see all these farms out there, how the heck do I know if they're safe, right? So that's kind of one of the reasons that these aggregators exist, whether it's us or some of the other various ones out there. The spot checks are kind of done for you beforehand.
So who develops the strategies, and how are the strategies approved?
So it's a mix of maybe a community member comes in and says, "Hey, check out this new farm," right? We have to rely on community members to give us alpha to say, "Here's a new hot thing everybody's talking about," because there's so much popping up all over. That may get fed into somebody like me who's also a community member. I was just never really mentioned at the top of the or introduction or whatever, but I'm just some guy that showed up on week one. I was like, "Hey, cool, a yield aggregating platform. I want to use this." And then I was hanging out, like, "Oh, do you guys need help in moderation of the channel?" And then I've been here now for like 9 months, and so I've kind of worked my way up into like a DAO like promotion org structure. And so you know, all the other moderators outside of the core developers who launched this protocol were just here as, like, in a sense, like, people who showed up really have a passion, and we have different skill sets. So for like myself, I maybe do social stuff. We have guys who write strategies, right? They know all the technicality. They can dive in the contracts. They can look for those rug pull things and what's the best way to code our contracts of those different platform contracts and build that money Lego. Then it's going to go to the core devs who are anonymous, and then they review it and make sure, okay, is this actually safe? Is this good for Harvest Finance? Go or no go on the strategy, and then it rolls out. So, as I mentioned earlier, like, Harvest Finance is very much like a commune kind of thing where anybody can contribute, whether you're just some guy showing up and saying, "Hey, look, I made some artwork. What do you think about this?" And maybe we use that in our logo or in the backdrop of our website, right? To people like me who are just, "Hey, I really like your project, and maybe I can talk on a podcast." To guys who are very, very good in code and they can write all this stuff, because what people don't understand about a DAO is it's really like a business, right? Like, you have all these various departments. It's not just about writing code. It's like, who's going to provide customer service? Who's going to do the PR? Who's going to do the artwork? There's a million different things that need to be done with these protocols. And I think people just think like, "Oh, that's a DAO. Just cast a vote and somebody writes some code and things get done." But there's just so many other things to running these protocols, like I said, on a social aspect that people don't think about. So going back to your question originally, so it is, we have a community representative, Jasper. He's really awesome. He kind of does all that prelim review. And then, like I said, it feeds up to the core devs who make that decision on final implementation.
Got it. Okay. And so what is a governance token in Harvest, and what's it used for?
So that's the farm token. It's got the dual purposes. As I was mentioning, there's kind of like a profit share aspect. So there is passive, like, revenue flowing to the token. And then there's this governance aspect. Again, it's not like a peer-peer DAO. We very much think of it as like a commune perspective where, like, hey, there's some owner, some farmlands, everybody contribute, everybody can have a voice. But, like, ultimately, the core devs need to make sure that any decision that is made is beneficial for the platform, right? So, like, the core devs are going to roll out strategies. We're not going to vote on everything of these strategies. Should we do this? Should we do that? Right? That's just kind of too slow. So they're rolling out these new products constantly. But if there needs to be like a change to, let's say, the token supply, Farm Harvest initially launched with 5 million tokens. Within a couple of weeks, it was realized way too much inflation in the token. Let's take a vote, and it was reduced all the way down to 690,420 tokens. Right, like a 90% reduction.
It's a very specific
tokens,
number.
Right? I know, it's very. We love playing on the memes. We're very, like, outgoing, quirky kind of community, and our community is awesome. We have people just commenting today how much they love our community. But ultimately, going back to the token, things like that are really critical to the fundamentals of the platform get voted on, right? But some of those like day-to-day things that would really slow you down, which we really need to vote on every single strategy that's going to roll out, like those are the things that kind of happen with core dev decisions. But again, like anything that would fundamentally change, like the farm token, economics, things that may change the direction of what the platform is doing, these things are definitely consulted with the community, and votes are put up like via snapshot.
Got it. Got it. And so this fee share, this revenue share, I suppose this is coming from the strategies themselves, right? So there's a percentage that is charged for the smart contract doing the hard work, as you put it, of putting the money into these different projects, harvesting the relative the reward tokens, converting them into the underlying asset, and then paying them back to the members. What does that look like as a percentage? Is it a standard, or is it changed according to the strategy?
So it's actually only changed depending on the chain that we're farming, right? So like on Binance Smart Chain, costs are like fractions of what they are on Ethereum, just because of the way that's structured, right? So there's only like an 8% performance fee, right? So the fee is only charged on the profits generated. So if you deposit $5,000, you're going to get $5,000 if you immediately withdraw it back. We don't charge like a deposit or withdrawal fee. It's all a performance fee, right? So if the platform generates $100,000 a day, $30,000 of that profit flows to everybody who's staking their farm tokens. And so that's actually really cool, because Harvest Finance has over 100 different strategies. So
Wow.
while you may be depositing only USDC and earning, whatever, your 40% on that USDC, we're also giving you some farm reward tokens as part of that 40% that you're earning. So now when you have your stake and farm, you're now connected into the profits of all 99 other strategies, or whatever number it is, right? So once you kind of deposit with farm, you become part of like the greater ecosystem, and tap into a much larger cash flow. And so that's what's really cool about the token and its specific intrinsic value.
It's very cool. And I'm looking at it now. You guys have got almost $280 million currently deposited, or in value equivalent, if not in sort of stablecoin, $280 million, and reading back a monthly profit to farmers currently of $48.8 million per month.
So that number's a little broken.
Is it? Okay.
Yeah, because what it does is trying to take a spot in time of like all 100 strategies, but I think the sushi strategy is throwing off a weird quirk in the calculation. So it's about $8 million a month.
$8 million.
The platform. So we have a ticket in trying to fix that. So I just want to put that out there.
$48 million is quite amazing. But so $8 million a month. I mean, that's still super solid.
I mean, it's an amazing return. Again, a sustainable return, and that peaks and valleys, but that's actually, we're at a low right now, right? So that $8 million is kind of what we've been cruising at, but we're in a bear market. When you see a bull market and all the values these tokens really pull up, you're really pushing towards like the 15 million, almost like double what that number is. TVL also inflates. So again, I think we peaked at like 1.2 billion in TVL, all the way down to 280 right now. So, it's just really depending on when you're looking at those numbers. I would more say so is just looking at the percentages of like the individual strategies and seeing the consistency in there. Like I said, high powered savings account with this passive income, which is, excellent consistency, right? As opposed to like kind of just looking at those raw numbers.
So I'm gonna sort of change the subject a little bit and go back to something you said earlier, which I think is an interesting statement, especially as there's sort of like there are difficult squares to circle here. So one of the things you mentioned is that DeFi is a bit of a difficult place to work out who's honest and who's not, and a lot of these projects are sort of founded anonymously, and you never know whether or not there's a backdoor or something that can be a rug pull on it, and that a large portion of people giving their money is the trust that they can place in those in the contracts and in the community and the developers and all that kind of stuff. Now, Harvest itself both is anonymously founded, anonymous developers, and I know that you guys have had in the past had a hack, it would be great if you could just talk through sort of like that process. Like, obviously you got, your community has rallied round you, as we've said, you've got 280 million still after all of this, but like how have you guys got around the issue, build the trust in the community despite having anonymous founders? And then how, like, just blow by blow, what happened with the hack, and then like how did you build up after that?
Sure. A lot of it is just showing that your product actually has a value. And then, like, what do you do, like, post stumble, right? Some protocols, they get hacked, they just kind of give up. To harvest, obviously, was a big deal. We tried to come up with a recovery plan for users lost funds. We made sure that we issued a bunch of technical reports and just tried to be extremely transparent about what happened, right? So kind of started at the beginning. I think I don't remember exactly which week it was offhand. I think it was like week 11. For some reason that stick out in my head, but again, don't quote me on that. But Harvest had been around a little bit a while. We had a bunch of TVL lock up in the protocol. People were really enjoying the fact that we were doing the hard work for them. And again, gas was really high at these points because that was like DeFi summer when everybody was trying to yield farm. Projects are popping up all over the place, and it was just the Ethereum networkers were just really getting bottled up, right? So we were the service of automation and compounding was extremely valuable at that point. But it goes back to what I mentioned with composability. Harvest could be perfect. Not saying it wasn't our fault, but even if Harvest is perfect, another project in a sense could be perfect. But sometimes you mix two components and then they don't interact correctly, right? Or if Harvest has a break and this one's perfect, so any kink in the chain or just some unexpected chain reaction, whatever, that can cause an issue. And so that's kind of what caused the hack. Basically, one piece of code, I think it was like get virtual price, or I think that was a piece of the code that the core does. I'm not a programmer, so I don't, you can't quote me on this stuff. But basically, it was like one sliver of code that allowed what's called a flash loan. Somebody's allowed to borrow funds and repay it all within the same transaction. And they were basically able to flood so much volume at once into our vaults. It basically tricked the price and broke a dollar coin, a stable coin supposed to be pegged to a dollar. It shifted its value to like $1.03, $1.05. And then they were able to cash out those assets based on that inflated value against our vaults. And it basically caused a drain on the vaults, right? Because they were draining over appreciated assets. So it was kind of like a loophole, right? So they were able to steal about $22 million out of a couple of vaults in total, representing about a 17% maximum impact to any individual user, right? So obviously that was a terrible experience. What Harvest tried to do to recover that was we issued the grain token, which is in a sense kind of like an IOU token that Harvest would slowly repurchase off the market using profits either from their own cut that they receive from the revenue, or like treasury, or even some of the profits generated by the platform in order to kind of like repay users. And so, like, in a sense, like an IOU, right? Then also just transparency. Here's exactly what happened. Here's all the people that we engaged with. Release another audit post that event with some auditors, third-party auditors. So there's just a lot of things that go into, what happened at that event, post-event, and then trying to recover from that. Like, ultimately, in terms of recovery, and still having good TVL within the platform, it's just showing, hey, we're still here delivering cutting-edge strategies. Just yesterday, I believe we're the very first protocol to be yield farming on Uniswap v3, where any user can come in and you can actually single asset deposit. So let's say it's like WETH USDC. If you have one of those assets, instead of having to do both as an LP, you can just come with your ETH, click deposit, and it'll do like a zap into both of them and then automatically create the LP, and now you're farming. So it's like farming even more simplified in a very cutting edge protocol that's Uniswap, where people were still kind of trying to wrap their heads around. Harvest is there on the cutting edge, delivering this brand new product that people don't have offer yet. So when you kind of see that, and you're like, I know you mentioned anonymity, and going back to that, I think people almost focus on a little bit because, like, didn't everybody know who Carlos Mato from BitConnect was, right? But like that didn't prevent you from getting scammed, right? Like, didn't they say like ICOs had a 95% failure rate? How many of those had some guys and their slick ties and these are my investor base and look at all my advisors? And you know who they were, and 95% of those failed. I guess you could call them scams, right? So if anonymity is a big deal, that only represents another 5% possibility of failure, right? So how much more does anonymity? So I know it's a little fuzzy math, but
I
like,
mean,
what I'm introducing there is people I think overly focus on just because I see a guy's picture means I'm not going to get scammed. No,
right.
You need to look at what does the blockchain say? What does the ledger say? So all things being equal, it doesn't mean you're not going to get scammed, whether you see their picture or you don't see their picture, right? Like, this is the Wild West. You kind of have to know what you're walking into. You have to kind of appreciate from the beginning, I can lose everything that I put into here, but you can also see like the technological viability, all these things that we've explained on this podcast, why they exist and why this is viable and why it may be worth taking the risk, right? Do your own research. This is not investment advice, but again, like all these things explained, you can see kind of pointing in the direction of why these are very cool products and why people can get into these. But again, don't be fooled because you see some guy in a suit on a website. You can still get scammed, right? Look at what's on the blockchain. Like, look at credibility and what other people are talking about, people who are in the know in the space. Don't listen to an Elon Musk. Listen to a guy who's actually in the trenches and who can read the code and who's providing tools like a VFAT. These people in the community that are really trying to willingly support and help volunteering to make this actual a better place, right? But again, I think too much is put into anonymity and, oh, this guy's face is in a website, and you're led by the Pied Piper of, oh, okay, this guy's willing to put his picture out there. It must not be a scam, right? So again, I said that a little bit tongue in cheek about the ICOs and 95%, but I'm just trying to paint this picture that people need to understand.
I agree, but I think there's a fundamental difference between running away with someone's funds and trying to build a business and failing, right? So like you can have there's plenty of startups that start up, take investors' money and then fail and never return anything. And that's kind of the rules of the game, right? And then there's the things that can happen where it is actually a scam. What they do is they put up a company, take money, and then never intend to do anything. And I think that in those cases, what you often expect is to be able to track that person down, and anonymity makes that a lot harder. And so there's often the question around, why is anonymity necessary? What is the reason for which I should trust my money and still grant the people who I'm trusting my money with the ability not to identify themselves to me? Not saying that identifying someone like decreases the likelihood of a scam, but it does at least mean that you know who you need to go and find the door of if you need to. From the
so where's Satoshi? Where do I set my complaint in Satoshi?
Sure. So just Satoshi, and like legitimate reason for anonymity. He believed that he would be shut down. He believed that he was actively breaking the law, and that he knew that, or he or the group of people that they knew from the experiences of building DigiCash and the experiences of building whatever the other one was, the gold-based one, that if they set up and they weren't anonymous, the Fed would come and kick down their doors. That was something that they'd actually seen.
But I think the other important dynamic is that it shouldn't be about Satoshi. It should be about trustlessness and what does the blockchain say? What does the immutable code say? And that is what, like, the point that I've been making. So it doesn't matter if you know Satoshi's face or not. It's what does the blockchain say? What does the code say? And so that's what, supposedly all of crypto is supposed to be about, this decentralization. It shouldn't matter about whose face is out there. It should be about what does the code say, right? And so that's what I'm trying to say is, like, get away from like caring about like this dude in a suit and his picture and knowing him. If this is really about DeFi and crypto, then it should be about what the code is, right? So again, I know the guy in the suit and the picture and being able to chase him down, but I ask you, like, how many lawsuits have actually come out of being scammed in crypto, right?
Quite a few. They just don't go
I mean, there's
public.
there's
So
some,
like,
but relative to the number of scams that actually happen, right?
so
So
if you
like,
look at the
again, maybe
SEC enforcement pages, it's 3 or 4 a week, and during the 2017, 2018, like they just don't get covered in the news. It's boring, but like there's plenty of enforcement actions. Like people have been dragged from the Seychelles, people have been dragged from all over the world by the SEC. SEC being the main guys that like go after people, but like more than you would expect. Honestly, more than you would expect.
and that's probably part of the reason, and not in terms of like malfeasance, just the fact that like an article came out today on CoinDesk saying like, oh, DeFi derivatives may be illegal, right? Did you see that piece?
Yeah.
And so immediately it's like, and now even if I'm not in the USA, you have to worry about somebody coming and messing with you, right? Like,
Right.
why do you want to deal with that as a person who's trying to just be on the cutting edge and delivering a really cool protocol, right? So
Right.
like, again, I completely appreciate what you say. Like, I'm just trying to give like my kind of perspective on terms of like, to me, like why ultimately, if you're truly in blockchain and believe in this immutability, it's about the code, the code, the code. And so, yes, like there can be some comfort, and maybe I should look into it, because I obviously thought like none of these people were getting persecuted or prosecuted on these scams. I'm like, man, everybody's getting away with this money scot free, right? But I think too many people just immediately put in this like suspicion of anonymity. It must be scary. And again, it's like, no, look, what does the code say? Because regardless of who the dude is behind that other screen, if that code is truly immutable and there's none of those quote unquote rug pulls or things behind it, then that's where you should be putting your trust, right? Not on like how fancy some website is, right? And I think too many people are distracted by those things.
So I don't disagree with you. All I say is that anonymity requires a higher bar for explanation. Like fundamentally, I think it's right. Like in DeFi, the law is so uncertain, and that anyone who is building these protocols is actually taking a huge risk, a huge personal risk in doing so. And if you want to move quickly, you've got well, if you want to do it, you've got two ways. One is doing it like fully buttoned up legal way, and where you go and get the lawyers and you going through like realms and realms of regulation, and you do it all that way, which is what we've done, is what we've spent a lot of time doing. There is a second way of doing it, which is just going, I just want to experiment, right? I just want to fundamentally be able to move quickly, fail fast, and I can't do that in an environment where every single thing has to be checked by a lawyer before I can push it out. And I think that that's actually one of the most important aspects of decentralized finance and the ability to build DeFi apps, is that ability to build quickly and fail quickly, because that is what separates it from centralized finance. That separates it from, well, I want to build a share broking company. Well, okay, well, you need to raise at least 5 million just to cover your legal setup, and then you can think about customer acquisition, which is crazy. And that's kind of why, I think there is a legitimate reason for anonymity, but I think the legitimate reason is fundamentally, if this is delivering value, you should be grateful that it's delivering value, and you understand that the people who are building it are actually taking large personal risks. And as long as they're then honest and they're trying to make sure that they're delivering a real product for real people, and they are not scamming them, they're not pulling money out. And this is, you're saying, look at the code, look at the community, look at the value that is being delivered. I think that is a deal that a lot of people can accept and be happy with, right? They can go, okay, I understand that I can't know who's founded it, but I can see the value it's delivering, and so I'm comfortable with that risk and putting my money in there. And that's kind of the pack that DeFi is offering, and I think that's great. I don't think that's a bad thing. I think it's pushing finance forwards in a way that it wasn't possible before.
Yeah.
Last thing to talk about is like, what's next? What's like, you guys have done Uni V3, which is awesome. Like, congratulations for understanding it. What's coming next? What are you guys planning?
So like immediately, one of the things that we've really been teasing is trying to refresh our UX, just updating and streamlining things, implementing like just a very, like I mentioned, we implemented like a ZAP kind of thing, where a single asset entry into an LP position, which normally requires two assets, and then wrapping into an LP token before you can deposit. So creating more simplicity, like we've actually having conversation with Zapperfy to have some more implementation or integration once we roll out that new UX. So trying to make it easier across the board for all users while still rolling out more and more strategies so that there's more opportunities for users depending on what assets they're holding. Looking at more layer twos or additional chains, whether it's expanding on Binance Smart Chain or moving to Polygon. And then the other thing that's really cool that we like to do is continuing to collaborate with other projects. We just worked out a collaboration with Convex, so we're building strategies to start pointing all of our curve strategies now through Convex, right? Just having private conversations with them and working out stuff like that. We have something that's called Council of 69, which is basically where we look to invest treasury funds that are kind of just sitting there and saying like, hey, are there other DeFi projects out there that are popping up kind of like in their pre-seed area, or they're just kind of still in development? Can we contribute? Can there be some kind of collaboration between the two protocols as well? So we've invested in Pendle before they kind of started coming up on the scene. Babylon Finance is becoming popular now, pre-seed on that. Complify, a really cool AMM derivatives platform that just launched on Polygon, partners with that. PerpFi, another one. So I think we've done 5 of these deals so far. So those are the things, 3 of those recently. So those are the things that we're trying to do on different fronts. Collaboration with UMA. So now users can deposit their iFarm, which then they can turn into Fcash via UMA. And so now you can basically borrow dollars off of your staked farm, which is automatically collecting from 100 different strategies, right? So just all these synergistic effects in addition to adding more strategies to make you more money, and just continuously improving the supercharge of the savings account that I mentioned before, right? Like that analogy, right? Trying to make our yield sustainable, lasting, and kind of just continually combing the farmlands for just deploying new yields, right? That's the continuous mission of Harvest.
That's really awesome. So if anyone wants to find out more, where do they go, and where should they hang out?
So our number one place is basically Discord. We have like 30 different channels in there. We have like 6 different international languages channels in there. The core developers hang out in there. So if you ever have an idea, if you're a developer yourself, you work for a different project, you want to learn more about yield farming in general, all of that's available in our Discord, because we have over 12 different moderators that are just there in different time zones. We love to answer questions. We have a very robust wiki. Like I said, we try to collaborate with people on a daily, weekly basis. Literally just had some guy come in today is looking to collaborate with us. We're pretty excited about. So trying to spark up conversation with them. So Discord 24/7, you're always going to get some cool action there. We also have a presence on Telegram, Reddit. So I would encourage people, if you really want to come and engage with the community. And as I mentioned before, we're like a commune. We're literally hiring developers. We're literally looking for people who write strategies. We're literally looking for people who can do artwork. If you have pretty much any kind of skill that you think could be supportive, and it doesn't have to be technical knowledge. Like I said, we're looking for artists, right? You can come there and find yourself some kind of niche and role where you can have a little bit of income. Like I mentioned, I'm just some dude that showed up, was like, hey, you want some help in customer service? And I've kind of turned it into a job, right? So there's so much opportunity. It's almost like I made this metaphor talking to somebody else. It's almost like Uber, right? Empowered anybody to kind of be able to become a taxi driver, and just this random revolution that came out of nowhere. And it's almost like crypto is and I was mentioning before, the DAO is so much more layered business because you need customer service, whatever. Well, who has the experience of running customer service for a decentralized autonomous organization that's ran by anonymous people, right? Who has that skill set? So randomly overnight, chat room people have suddenly become super in demand. So if you can talk on a podcast and you can have good customer service skills in chat, you're in demand, right? How crazy does that sound, right? But it's really there's headhunters. I've been contacted by headhunters, and I decline a lot of those because I only want to work for projects I'm really excited in. I don't want this to be job where I'm collecting a check. Like I want to be super excited about the projects I'm working for, but there's opportunities out there for people like that. And I just think that's so cool. It's not just about the earning power necessarily in DeFi. Like this is truly becoming like its own viable ecosystem, from ground up, everything from employees, to making money to legitimate products. Like this is actually something that's growing and becoming awesome. And you see that in the news, right? Governments now accepting Bitcoin. Like there is a lot more legitimacy to Bitcoin and cryptocurrency in general than there was just even 2-3 years ago.
What an excellent ending thought, Red. It's been such a pleasure having you. Thank you so much for coming on the show.
I appreciate you having me. I look forward to chatting again.